Good afternoon, everyone. We're just going to give the rest of the attendees, participants, just a few more minutes or another minute longer to populate to the room. Well, good afternoon. Thank you, everyone, for carving out time to join us today. We hope this finds you and your families staying well and healthy during these times. My name is Ryan Buckley. I'm a partner in Livingstone's healthcare practice, and I have the pleasure of serving as your moderator today. Before I introduce my partners and your panelists, allow me a moment to address a few programming items. All participants will be muted during the webinar, but we will be having a Q&A session at the end. If you have questions, I'm told if you hover over your menu bar at the bottom of the screen and click on the Q&A icon, you'll be able to submit your questions in writing, and we promise to address as many as possible. If we can't get through all of the questions, we will be happy to set up a separate call to either dig into your questions or other topics you'd like to discuss or any specific opportunities that you may want to discuss with Livingstone. Finally, the discussion will be recorded, so for those that find the content so insightful as to want to watch it again, we'll be able to do so via our website. So without further ado, I'll turn it over to my partner, Jim, for introductions.
Hi, I'm Jim Moskal. I co-head the Healthcare Services Group here at Livingstone with Ryan. Been doing middle market sell-side M&A for 18 years with a concentration for the last 12 years in healthcare. Our practice here at Livingstone, about 2/3 of the deals we do are provider deals. We've done a number of deals in physical therapy, home health, physician practices, autism, IDD, and then the remaining third of the deals we do in healthcare are really outsourced service deals. Joe?
Good afternoon, everyone. Joe Greenwood, partner and head of the Special Situations practice at Livingstone. Within the Special Situations group, we focus on distressed M&A, distressed refinancings, and balance sheet restructurings. Our distressed M&A capabilities and common transaction structures include 363 sales and bankruptcy, UCC Article 9 sales, state foreclosures, state receiverships, federal receiverships, assignments for the benefit of creditors, debt sales, and regular way out of court asset sales. I've been in the distressed M&A and restructuring space for the last 20 years and look forward to the conversation today.
And I'm Mark Birkett. I'm a partner here at Livingstone in our debt advisory practice. We assist clients with non-control capital raises to support acquisitions, refinancings, growth, recapitalizations, et cetera. I've been in the middle market lending sector for about 17 years, half of it in an advisory capacity like this, and the other half as a middle market lender.
Thanks, guys. So to set the stage, over the last decade, the healthcare industry and healthcare providers in particular, across all different types of medical subspecialties, have undergone the most significant period of consolidation in history. As a consequence, there has never been a time in which more healthcare providers have been directly or indirectly owned by private equity funds. And as a further consequence of that, the healthcare provider landscape has never been more levered than it is today. By our count, private equity has backed over 100 physician practice management transactions over a range of specialties, around 100 dental service organizations, over 25 physical therapy platforms, and a large and growing list of other consumer-facing healthcare businesses. The investments in these areas have long been considered recession-resistant, if not recession-proof, but this economic downturn and the unique characteristics of it have acutely affected platforms in the healthcare provider landscape. While these impacts of the shutdowns have varied in degree, whether by region, provider type, service, and in the nature of that service, you'd be hard-pressed to find a healthcare provider business that hasn't, at best, experienced a very material decline in business volume, and at worst is still managing through a liquidity crisis while they're attempting to restart operations in the face of changing business and economic realities, which further creates uncertainty. Over the last few months, Livingstone has held extensive conversations with lenders, executives, attorneys, private equity investors on the topics of distressed healthcare M&A and how to prepare for the difficult negotiations that many will have over the next couple of weeks, and how to participate in value-oriented investment opportunities. We believe we've got a unique vantage point in that context, as we've completed and are active on numerous distressed healthcare transactions. And areas where we have completed transactions include dental, physical therapy, physician practice management, home health, behavioral health, medical equipment, and so on. So today we plan on boiling down our views on distressed healthcare M&A in really three specific topics, which we have on the screen here. The first of which I'll ask my partner Joe to address, which is what he's seeing on the front lines and how lenders and borrowers are approaching the pending wave of covenant defaults.
Thanks, Ryan. Look, the 3 months from March, April, and May and into June were obviously incredibly difficult, and there were many difficult conversations that were taking place between borrowers and lenders over that time period. And if I could oversimplify it, I would say that there's two key words that kind of dictate the direction and the tenor of those conversations. And the two key words and two key factors are, I'd say, liquidity and equity cooperation. What we have found in both the groups that have approached us and the number of institutions that we're talking to on a daily basis, for borrowers that have ample liquidity, 4, 6, 9 months liquidity, we have found that the lenders have been very open to concessions, amortization holidays, etc. The real troubling conversations, and I'd say where the rubber really meets the road, is where you have real near-term liquidity constraints, i.e. not going to make payroll in a couple weeks, etc. And you've got a lender who is being asked to lend into a credit to basically fund a runway through this pandemic. And in our experience, what we've seen is the lenders are looking to the equity to play a role in that solution. And where the equity is participating in that solution, the lenders have been almost universally willing to play ball and come up with a plan that works for both the borrower and the lender. Where the equity holders are unwilling to participate and play a role in the solution, that's really where we've seen lenders picking winners and losers and deciding which ones they're going to prop up and kind of which ones are going to win and which ones are going to die. And if you look at kind of the businesses that have been in market over the last 3 months, the businesses that are coming to market and will be in market over the next couple weeks, those are the conversations that are taking place, and really the catalysts and conversations that are putting those businesses in play from a capital market standpoint. And frankly, those are the conversations that are going to continue to take place and will ultimately be the drivers in deciding which businesses become capital markets options for people on a go-forward basis, because the companies that had 6 or 9 months of liquidity 3 months ago, they're going to be having a very similar conversation several months down the road. So that's really what we're seeing kind of on the front lines as far as the hand-to-hand combat between the borrowers and the lenders.
Thanks, Joe. And I think we'll come back to what it means in the context of a distressed transaction to be put into play and what that could mean both in court and out of court from an M&A perspective. But before we do that, I'll turn it over to Mark. If you could address what you're hearing from lenders specifically in terms of what is the art of the possible.
Yeah. Thanks, Ryan. Obviously there's been high interest in the sector from private equity over the last several years, and in turn, high interest from lenders. And so virtually every private credit firm out there has some exposure to the PPM sector, the DSO sector. And that interest has driven enterprise values high, and that's certainly been supported by high debt levels. And as you mentioned, around the assumption that these were largely insulated from macroeconomic factors. And obviously that's been proven not to be the case. And so during the stay-at-home periods here, we've had leverage levels that were already high become higher, while at the same time, leverage levels that lenders in general are looking for in the market have at best come down a little bit, and perhaps certain sectors come down even further. And so you've had leverage levels for these businesses moving in the wrong direction. And the conversations that I've been involved in with the distressed businesses generally start with some sort of a refinance. How can we refinance out our existing lender? And it's in these situations, there truly is no debt for debt solution. And I think people are beginning to realize that we're not going to be able to simply take a LIBOR 550 deal and replace it with a LIBOR 750 or 800, or pick the interest rate. That solution just doesn't really exist. And so then you start moving down the capital structure, and there's certainly been a number of structured equity, flexible equity firms that have come into the market over the last 36 months, and many of them raising incremental capital here in the last 6 months. And that is certainly an option, and it's something to be considered. At the same time, through our transaction experience here at Livingstone, we've definitely seen that as you factor in some sort of a pick rate and then the structure features, whether that's a liquidation preference, warrants, et cetera, the all-in economic cost of that junior capital can sometimes be a little breathtaking, especially to private equity owners. And then you layer on top of that some of the requirements for control that may be coming from these minority investors. And at times it's proven to be a tough pill to swallow, and has forced people to explore incremental options. And so then what we find happening, I think, as you suggested, is the art of the possible, which is a phrase we've probably heard more in the last 2 months than we've ever heard before, becomes let's look for a more comprehensive solution, or let's evaluate all the options on the table and what actually can be done given the situation that a business is in.
Thanks, Mark. And I think that's why we believe we're well positioned, to advise clients on that comprehensive solution by being able to bring that healthcare expertise with debt and special situations capabilities. But Mark, maybe I'll turn it back to you again in terms of when the time comes to approach those capital markets, given that businesses are restarting and may or may not be back to some level of normalcy pre-COVID, how much runway do borrowers or your clients require in terms of trailing performance in order to get credit, if you will, from the lending community?
Yeah, it's very industry specific, and I think it's actually still evolving as well. We're learning real time. Joe and I are working on a couple of situations for businesses in various states of distress, one more of an industrial exposure, the other in the healthcare services sector. And for that industrial business that's participating in a more complicated supply chain, probably a view that the macroeconomic cycle here could impact the business longer term, we're recommending 2 to 3 months of positive performance before we take that business out to potential investors. And on the flip side, for a healthcare services business that we're working on, that we're measuring that more in a matter of weeks. The green shoots, the revenue cycle is a little more straightforward. Patients are calling in, making appointments, showing up at the door, and so you can start to get comfortable that demand is coming back a little bit quicker. I know Jim, through a recent transaction, has some very real-time experience with this.
Yeah, thank you, Mark. We recently closed a healthy autism deal just 2 weeks ago. Through our process, they had performed very well up through mid-March. Ultimately, volumes dropped, and this was a home-based autism business. Volumes dropped about 40% by late April. And then each week, and we were looking at weekly hours billed, from late April, they started to increase. And ultimately, by mid-June, came back to about 95 to 100% of pre-COVID levels, as again, parents were more comfortable having therapists come in to treat their autistic children. We ultimately, from mid-June to about mid-July, had about 4 weeks of performance that got the buyer comfortable. And again, then we moved to a close. So that's just one example with the kind of visit or hour and revenue per visit or revenue per hour model that buyers can get pretty comfortable. Of course, they were already comfortable with the demand dynamic within their local market.
So Jim, what you're talking about there though, and Mark as well, which is in many respects, business volume coming back to some level of pre-COVID, which is really kind of top line revenue at the end of the day, but there's still meaningful noise in provider financials broadly, and in many respects, the underlying earnings could be better in some cases if costs were taken out of the business, but in many respects, there have been, additional costs and operational considerations that that our clients need to take into consideration. So, Jim, what are some of those factors that you've seen?
Yeah, thank you, Ryan. There's a couple. I think first is just, of course, increased expenses like personal protection equipment, PPE, and that's for providers whether you're in the home, like autism, home health, or you're in a facility. Like physical therapy, many physician practices, that for your healthcare providers, that's an additional cost these days that obviously never had to be factored in before. A second one is just really the care delivery model, particularly for the facility-based and in-office providers. You're not going to, because of social distancing requirements, because of sanitation requirements between visits, you're simply, at least right now, not going to be able to achieve that pre-COVID level throughput that you did through your facility or your office because of those constraints, again, due to social distancing. And of course, additional costs for sanitation. So that's one thing, or another thing to consider. Another factor that's played in is telemedicine. Telemedicine has both pros and cons. Pretty immediately in late March and April, you saw payers approve telemedicine visits for certain subsegments of healthcare that they had never approved before, and they did it rapidly. And that, for many, many providers, was a lifeline, being able to switch to telemedicine visits. That helped support their volume, so that was a huge plus. I think when you think of telemedicine on the negative side, is there's only so much you can do in a telemedicine visit. For example, level 4, level 5 type of visits, you need to be in office, at least on the primary care side, to be able to execute those. Those are higher acuity visits, level 4, level 5, to be able to perform them, be able to bill for them. And so there are certain things you simply cannot do via telemedicine. So you saw many providers use telemedicine to stabilize volumes. However, their revenue per hour, revenue per visit went down meaningfully.
Thanks, Jim. And assuming that you're capable of getting comfortable with the numbers, and it just is so important, critically important to dig into all of these varying factors that can change performance. I mean, the practical element then comes down to in healthcare providers is getting that provider alignment. What strategies, Jim, have you seen used to ensure that providers are aligned in the context of a distressed transaction?
Yeah, thank you, Ryan. I think it depends on what type of provider you're trying to sell or raise capital for. Somewhat like home health, like physical therapy, again, autism, whether they're clinic-based or in-home, those are spread out among hundreds or maybe thousands of providers. So you don't have revenue concentration within the provider set. Now, you may want to, of course, incentivize the owner, former owner, executives that are running the businesses. But where we really see this in getting provider alignment is in physician practices, where maybe 5, 10, or 15 of the physicians really control or generate, I should say, a majority of the revenue. In those instances, it's very important that the buyers will require that the providers, who's probably equity, if we're talking about a private equity transaction, while they got liquidity in the first transaction, many physician practices end up the owners or physicians still own 35, 40, 45% of that business. That equity's underwater. And so you're going to want, any buyer's going to require that those providers, those physician providers, are incentivized in a new transaction going forward. And you have to do that in a compliant way, but you can do that via transaction bonuses, co-investment, equity incentive programs going forward. Again, very important when you only have maybe 5, 10, 15 doctors generating all the revenue, that they're on board with the transaction. They're not going to be happy, right? Because their equity's underwater. But I think we sell them as like, okay, a new buyer, a new day, a new opportunity to generate equity returns.
And one thing I would add, likely a very opportunistic and low valuation at which to attach going forward. So
yeah, great point, Joe.
A good way to kind of cost basis, level set the valuation going forward.
Certainly. So Joe, you've completed and are active on a wide range of distressed healthcare transactions. We've talked about provider alignment, the noise in the numbers now. What specific complexities arise in the context of a distressed healthcare transaction?
Yeah, I mean, provider-based transactions can be very challenging and difficult in healthy environments. So certainly, in a distressed world, it's another layer of complexity. I think at its simplest form, as we think of a healthy provider-based healthcare deal, these are typically stock purchases as opposed to asset purchases. In a distressed world, it is almost always going to be an asset purchase. And look, a stock purchase, goes a long way in making it much easier to maintain kind of entity and organizational continuity. And there are not the layers of complexities that there are when you need to consummate a transaction by an asset sale. We could talk about this, for an hour, but I think one example that I'd highlight would be the transfer of provider agreements in light of kind of Medicare and Medicaid change of ownership requirements. In an asset sale, that constitutes a change of ownership. While the company can transfer the CMS certification number as well as the participation agreement, the purchaser will need to apply for a new provider transaction access number for the new business going forward. So what does that mean as far as continuity, transition services? In the interim, the buyer and the seller can enter into an OTA, an operations transition agreement, that allows the purchaser to utilize the seller's existing provider transaction access number while they are awaiting, the several month process of the buyer obtaining their own new provider transaction access number. This is one level of complexity and one layer that you just don't have to deal with when selling a healthy provider based healthcare business via stock deal.
Thanks, Joe. And I'll add one other point here, but just for those participants on the line, encourage any questions that you may have. Again, at the bottom of your screen, the Q&A button, if you click there, you can write those in. And in just a minute, we've got a couple that have come in and we'll address. But one other complexity I think, Joe, that you didn't end up touching on here is, in many respects, trying to sell a healthcare provider business in a healthy context can take anywhere from 5 months on the low end to maybe 6 months on average or longer. And in the context of a distressed transaction, you just don't, particularly if it's in court, you just don't have that kind of runway to get alignment with the providers and the management team and a lot of those complexities that you were just talking about.
Great point, Ryan. Thank you.
All right. One of the questions we received was, and this is from Mark, what else are you seeing driving lender decision-making in this current environment?
Yeah, good question. I think Joe mentioned it a little bit at first, the level of equity support, the level of equity cooperation that's taking place. That is probably A1 on the list of what's going to drive lender behavior. Beyond that, I think in a very informal survey of lenders that I'd done in advance of this call, just trying to get a sense of how people feel about the sector in general, I would suggest that there are a large number of private credit firms who if they had their druthers, they would no longer, at least in the near term, invest in the sector, and maybe including be invested in the sector today. I have a feeling that will change as things normalize. But right now, the idea that somebody's going to look at a new platform is there's fewer lenders that are willing to consider the platform, or they can be much more discerning. And then the last one, it's a little bit maybe inside baseball, but there's the idea of a borrowing base at these lenders. And so for ones that are truly distressed, where if they're using a leverage line to lever their own returns, could you end up with a scenario where the lender is making decisions more based on what their lender is going to require them to do with the loan if it's deteriorated too far? That one's maybe a little bit further off in terms of businesses truly being distressed, but it's something that you can't completely discount.
Thanks, Mark. Another one that has come in, which is kind of a two-part question, and this would be, I think, probably best answered by Joe or Jim, is, what is the general sentiment of buyers and sellers in this current marketplace? How are buyers and sellers viewing what is likely a buy-sell disconnect from a valuation perspective? And we had another one, which I might as well ask since you'll have the mic, Jim, which is, where is Livingstone Street?
Well, Livingstone Street is right here in my office, so we obtained that sign long ago. But to your first question, and then I'll let Joe jump in. Yeah, from a standpoint, I think that, listen, in healthcare, the healthcare services, particularly providers, which we've concentrated on today, valuations in many of the subsegment of providers were at all-time highs pre-COVID. Physical therapy, that was definitely the case. Home health, just about all of the physician practice management businesses, DSOs. Again, autism is a sector we've done a number of deals. So you're talking about coming off a long bull market in middle market M&A, valuations at all-time high in many subsegments of healthcare. So the simple answer is, yeah, valuations for healthy deals have absolutely come down. I think that's just a function of some of those valuations probably weren't sustainable, number one. Number two, the leverage markets aren't going to support post-COVID some of those valuations that you saw pre-COVID. And third is probably private equity firm buyers in particular are dealing with their own portfolio companies and maybe having to deploy resources, time, capital there as opposed to hunting for new platforms. So that's probably on the healthy side the answer. Joe, I don't know, you want to jump in?
Yeah, I would just say specifically with respect to healthcare, for the universe of special situations buyers or value-oriented sponsors, I'd say, healthcare over the last several years, these businesses have been, I'd say, more aspirational, if anything, just because of the valuations and, where things were trading at, call it 10 to 14 times, 12 to 18 months ago. So a lot of these special situation sponsors and value buyers were essentially priced out of those assets. And, really with, the dynamic of the last several months and the recalibration, we're getting a significant amount of inbound interest from the special situation buyer community, specifically looking for these types of businesses because of the attractive entry point, which the current environment may or may not allow.
Thanks, guys. Well, with about a minute left, we got another question that has come in, which is comment on the lending to nonprofit provider sector and any unique challenges you're seeing. And I might just augment the question just a little bit to both lending and transacting just broadly. Jim, I may turn this over to you as, having within the last year sold assets out of Northwestern Memorial Hospital. perhaps address some of the key challenges or learnings that you had during that transaction, and then Mark, if there were any unique considerations as it relates to lending into the nonprofit space.
Thank you, Ryan. From an M&A perspective, I think with not-for-profits, there's a couple of unique things. One, the non-for-profits absolutely have they have a mission, right? So they're very sensitive to things to really kind of headline risk or bad news. So the not-for-profits want to make sure that they're not going to lay off a bunch of people before they sell an asset. That's important. They're going to want to make sure, first and foremost, really, that the patient base, that if they're selling a particular asset, that patient base continues to be served regardless of the payer, Medicaid, for example, patients. Those are some of I think, the little more unique challenges or attributes when dealing with both selling non-for-profits and, again, buying not-for-profits as well.
Yeah, I guess on the lending side, it's a very nuanced question. The experience that I have in the nonprofit lending side, the primary concern, similar to what Jim had suggested, that if you are lending truly to a nonprofit as opposed to a nonprofit that maybe is migrating to a for-profit, has been the headline risk associated with a lender not wanting to potentially have to foreclose or take some sort of adverse action against a nonprofit that could sort of raise the negative press that would be associated with that lender taking that type of action and putting that nonprofit into some type of challenging situation. And again, similar to what Jim had said, that the thing there is if you have lent to one and it's underperformed, you face that unique challenge of a lot of times those businesses do care very much about the employees, or I'm not to suggest that for-profit doesn't care about employees, but there tends to be that mission aspect of it from management, and the idea of trying to maximize profitability or maximize cash flow in a challenging situation is just not what they're set up to do and not how they've typically thought about the business. And so trying to convince that management team to shift focus can certainly be a challenge.
Well, thanks, gentlemen, and thanks everyone here. That's a wrap for us. We appreciate you taking time on a Thursday afternoon to spend with us. If we can be helpful in any way, address any questions or opportunities, please do not hesitate to contact anyone from the Livingstone team. Again, we appreciate your time. Take care.